us. It talked about a few of the things that we're going to go over again today, and what's really helped us in the market for equities traders and ETF traders, index traders, stock traders. This is a phenomenal book. It's not your typical book. In fact, we don't really talk about I don't even think I've mentioned Bollinger Bands once in here. It's not my thing. I have found through the years more reliable indicators, and in here it really is an awesome book. We also, many of you are familiar with this. This book here didn't make a lot of popularity, and one of the reasons it wasn't very popular is because of that keyword, commodity. But what people missed was that I gave out when I came into the program to say, hey guys, this is what my idea about commodities should be for equities traders, is look for high correlated stocks to underlying markets. And that's what we put together. And then again, through the advent of Kindle, book sales, John Wiley and Sons, they killed the project. But it was in publication for, I think, 7 years. Really, I still keep 13 on my books. Someone emailed me last week saying, hey, I can't get the book. Well, that's right. We're working on maybe resurrecting this, but in the meantime, this book, awesome stuff, and many of you are probably familiar with what we talked about in there. This is the indicator that's formerly used by the masses on Thinkorswim, which we gave many presentations on how to use it, especially for scanning and looking for stocks that are populating before they launch the sector. And that is something we might have a little chance to get into today. Persons pivots, and then of course these two, the HCD, LCD scans, and then yesterday I tweeted out something, if you've followed up with the tweets, this thing called the last conditional change breakout. And that LCC was something that was first published actually in the next book that I'll share with you in a minute. But for some of you who aren't familiar with my work, this is kind of like the cornerstone of what I do. And of course, I'm a member of APTA, and that's just a professional technical analysis of society's, professional society membership. We got a bunch of people in there that are, really nice people. Awesome organization. That's the book right there, Candlesticks and Pivot Point Trading Triggers. It came and did backtest studies. The first time anyone did backtest study on the relevancy of what formed highs and lows of markets in a given time frame. It was this book right there. I'm proud to say it's in its going on its 11th year. So that was over 11 years ago, and people weren't really familiar with dojis as much, and I helped popularize that, and pivot points and moving averages of pivots and things of that nature. And that's the one that kind of really launched, I guess, the resurrection of the popularity of pivots. And so that one's going into a second edition version later this year. And so I'm just absolutely buried with work, and this is just, there's just so many fantastic stuff that and we'll share today, and just to to kind of go back and back test and share you with what's moving. We do a lot of stuff with trading software, and we definitely teach not just individuals but also professional. Lots of professionals come to me now. I think this market, overall stock market, has been something that has been, again, the keyword tricky. And one of the things that we've noted, and I've done this for probably like the last, correct me if I'm wrong guys, 18 or so months, is I give this example that the markets are being treated and swayed and manipulated like a swarm of locusts that go from one field to another, suck it dry, jump over to another one, suck it dry, go to another one, suck it dry, go to another one, suck it dry, and they just go from sector to sector. And you know what? In the meantime, the indexes just grind sideways. They're going from utilities, the XLU, then they get out of that and they go into maybe biotechs, back and forth, back and forth. 2 weeks ago, every Tom, Dick, and Harry hedge fund manager said you got to be in gold, and they like gold. I wonder how they feel about it today. And you know what? Some of our stuff we actually went through, just like what we do and how we teach people and how we provide really outstanding information is that we put together our thoughts through applications with the TradeStation trading platform and our packages with Trade Navigator software, and of course our license study on Thinkorswim platform. We have private mentoring. We do semi-annual seminars. We have online trading courses and a trading room and weekly advisory service, and we'll talk about some of that stuff. The last time we visited, just to get a little house cleaning out here, I told you we have this Mediterranean cruise. We're leaving there June 12th. We're going to be in Spain, France, and Italy. It is going to be just an incredible fun time, but that's the kind of things we do. Put together good stuff with advanced traders, and then the next event that we're going to have is right down here in Florida, and I'm not joking about this picturesque view. It is Palm Beach, and it is awesome. We're going to be together for a 3-day seminar here in Palm Beach, Florida. You can certainly get a hold of our website, contact us, and say, give me some more information about that. All right? So with that said, let's take a look at the Grateful Dead colors, right? The tie-dyed T-shirt. This is something that I've been looking at, not just relative strength, but sector performance, and a couple of little things that we wanted to share with you. This is live as of, I'm going to say I took this screenshot right before the market closed. What are we looking at? We're talking about the beginning of the year, and we're talking about sectors. So the one lone sector, the worst one in the year, down 19.7%, is biotechs. So what does this do for me? Number one, it tells me the strength in numbers concept. You know, we look at breadth analysis for stocks. We've gone over McClellan Oscillator in past events. We've gone over my AD lines that I use for other stock indices. But it's not just that. It's also the rate of measurement. The rate of measurement. Measurement's a big word for traders. We measure how many stocks are at 52-week highs, 52-week lows, what the implied volatility is measured against the 52-week high historic volatility. So measurement's always an important element. We're looking to measure something against something. In the old days, they used to say you're keeping up with the Joneses. You know, you're measuring your wealth against your next door neighbor. He has a new car, you got to get a new car. So, you know, the rate of measurement is very important, if you can imagine that, right? So what makes one guy a better analyst to be able to put on better trade decisions, right? And then define those trade decisions. Well, I think what we've been talking about and sharing with the world is simply, you know, if I'm looking at the market to crash, burn, dive, then I would start to see more and more sectors going from positive above the zero line, this is the zero line, the black line of sand, to negative. So if we are going to get a crash, and if the market is going to, you know, go to hell in a handbasket, then more than likely we would see more sectors going bearish and going down on the year. And it's ironic that over the last couple weeks, and it might be hard to see this, but since kind of like we peaked out right around in this time frame, this is where we had 1, 2, 3, only 4 sectors. There they are, those 4 right there, which was the XLF, the XLY, the KRE, and the IBB. Those were your 4, and around April 26th that were negative on the year, and everything else was positive. After that, everything started to fall back down, and then at the worst case scenario last week and the week before, we didn't really see a massive disimprovement among sectors to go negative. We were at 9 sectors negative. We were 9 sectors negative, and now all of a sudden we changed on Friday to only 7. So for the 2 weeks that the market was kind of grinding lower, we never saw a massive disimprovement. And that's one of the things that I follow distinctly. Many of you, I shared with you, you know, this is something that I put out. As you can see, it takes a little bit of time. Created 5/22. We send this out on the 22nd. this is my weekly thoughts and observation, but just take a look at the key bullet points, right? Just to prove a point. A couple things we look at, technical point of interest. How many stocks? We have, as I was just pointing out, 7 sectors negative on the year compared to 9 for the last 2 weeks. So it's not something that we just made up just to impress you guys for today. It's absolutely an imperative rate of measurement. The more sectors that are getting positive and the more sectors that are, in this case, and it might be hard to see, but the Barney fuchsia purple color, that Barney color, that purple, right? Barney semiconductors started to get more positive, right? The XCI, computer, software, hardware sector started to get less negative. Biotech started to break out. We started to see more positive movements. The irony is that if you recall, when things were really negative, it was utilities that were positive. XOP is still the strongest year-to-date gainer in the market. So subsectors is part of, instead of just looking at technology, XLK, we look at some of the specific subsectors that can help us. Biotech instead of healthcare, XLV, semiconductors instead of just XLK. So what I'm trying to impress upon you is, you know, that old adage, the devil's in the detail? That's very important. Now, a couple weeks ago when we were here, I gave a specific warning about the seasonality of gold. And I stated, gold in the month of May and going into July is not a very healthy move. We talked about different ways you could trade it, GLD, DZZ, you know, 3 times, 2 times, ETNs, different ways that you could trade gold, right? And with that said, these are the slides. I wanted to go back, and actually this is the exact slide. I know this is posted still, and it's still on YouTube, but I said, guys, this market is rallying, and there's no volume behind it, and this is like the seasonally worst period of time. I said the hedge funds are historically long. Since I've been talking about this, I know more and more people are picking up on the Commitment of Traders report. I noticed that, right? And what's interesting is that one of my comments that we put out when I did this, I want you to read something, because you see this chart actually comes from not just a presentation, but here is a one of my weekly thoughts. Look when this came out, 5/14. So this is not new, right? So this hasn't been altered, right? So what I put out in that particular week was gold. Just check this out. I mean, more hedge fund managers are touting their long gold and staying in it. Perhaps that's one reason to worry. If everyone's in, who's going to continue to buy? And what if one big hedge fund decides to take a profit or liquidate a position? It's going to be musical chairs to see who can liquidate first or faster. And that is exactly what we just saw happen today. Now, let's move forward. GDX. Remember I shared, this is the other seasonal chart that I put up with GDX. And I said, listen, guys, there's Nugget, NUGT. It's a 3-time long ETF, and Dust and JNUG for the junior miners. And then I came over here and I said, but here's what we like and what we're kind of looking for, an upside move for biotech. And there's 3 ways to play it. XBI is one of the ways that we've played it in our trading community, and as well as hopefully some people have exposure with IBB. Some of my comments, because of the seasonality, and remember, I always try to be thorough, and I tell people, everyone's looking at seasonal analysis, but seasonal analysis trends is not the end all. Technical analysis and market conditions are. So this was actually a quote in the weekly thoughts and observation, guys. And then we'll get right into the down and dirty, how to look for these things in just a minute. But looking at the weekly for the May 16th thoughts, right? An area I'll be looking for selling would be OIH, and from a seasonal trend perspective, biotech, semiconductors. Boy, that is a buzzword right now. We talked about this 2 weeks ago, and system software stocks. I encourage traders to watch for intraday 60-minute and end-of-day PPS buy signals, and I gave out specific names to do so. Now, if that's not enough, right, one of the other things we talk about is the biotechs. They have not performed positively, at least not yet, but you should be watching for a daily PPS buy in IBB as well as XBI for long triggers. Also, watch XBI for a daily close above 52.70 to trigger a long entry. That was a very powerful statement, and there was the chart. There was what we're looking for, and that's kind of like the analysis that we would put together to help traders to say, listen, it's seasonally in a strong area, but here's what's really key. The sector ETF is trading at, number one, you're going to like this if you follow my work, if you've used monthly person's pivots, we were right at pivot support, that green line in the sand, person's pivot support. The market formed a lower price low, stochastics was giving us a bullish convergence, and OBV was giving us a bullish convergence. All we were looking for was that pop and a daily close over 52.70, which we got a week ago Monday. So that, my friends, is if we see the biotech and if we saw some of these semiconductors and the technology stocks, we're going to see a liftoff in the market, and that's exactly what we got. So this is XBI, and I'm using TOS and I think this was taken not much further from the close. So the trigger was right here. That's the day we closed right above the 52.71 the 52.70 last conditional change, and we had a little uptick on volume, right? You had that little PPS buy signal, slight little pullback, nice entry, and then launch. Yesterday, I sent an email out, guys, we got a little bit of launch. We're getting a little overbought. It was a pretty big move for this sector in this environment. Take half off, move your stop. And at this point in time, most of my folks should only be in a half position on this and with stops underneath yesterday's lows. So the XBI came into its own. The biotechs came into its own. I'm not looking for this thing to soar, even though the monthly person's pivots is way up there. Let me tell you something. The month ends next Tuesday. We've got Janet Yellen going to talk her head off a little bit at Harvard on Friday. A couple other little things we got to get through, like Wednesday, Thursday, Friday. And so I'm thinking maybe we got to temper our upside to just testing these highs or just about that moving average crossover zone right there. But at this point in time, XBI, this is one of what we call it's a fresh new last conditional change candle, stops underneath that candle pattern right there, that low of that day, and because the moving averages, now tomorrow is going to be measured in a graphic form by representation of the chart itself, right, at about this level here. If you look at that white line or red line now I'm drawing, just it'll be below the moving average component. So if you're trading on Thinkorswim and you wanted to be looking at this, I think over the next couple days, as long as we hold above that level, there's a little bit more left here in testing not just the absolute high, but the moving average crossover level. That's around that 57 handle. So I think there's probably another 3% left in the market, and quite frankly, that'll end up being about a 10% move. In this year and a half, we've been seeing a lot of 5, 10, and I'm going to put that in parentheses because that's a rarity. But 5 and 10% moves of a sector and a stock, that's an LMO RFN order. What does that mean? That means it's an old floor traders acronym. Let me out right freaking now. It's the kill button. It's the get out of the trade. And I have no reasonable explanation to say in this environment, or at least to tell anybody, hey, let's power play this thing. Let's just keep adding to longs, because we are not by any stretch of the imagination in a rip-roaring bull market. We're in a trading range. That's at best what I'm thinking, and that's what I have been thinking. In fact, another thing I was thinking is many of you get the Twitter, I'm going to share a couple things with you, because, I mean, please don't laugh, but I do send some funny tweets out once in a while, but I do it when in regards to the market. Last week, for example, that's my grandson, right? And I had to bribe him with that cookie right there. I don't know if you see that, but I had to bribe him with that cookie. Otherwise, you know, he sees all this lights and camera and all this stuff blinking, and he didn't really care. What you can't see is up on the wall back here is a big old, a little flat screen TV on the wall. And I had to put SpongeBob on to keep him happy. So anyway, and quite frankly, I think it was more refreshing than watching some of the media TV. But with that said, I think a lot of people were talking about this market being a head and shoulders top. And I mean, I couldn't imagine a more powerful key reversal signal than a head and shoulders top pattern that fails and goes up. It becomes a breakout, and then you get into a different type of channeling type pattern. But with a head and shoulders, if you follow with what I'm saying, in the last week or so, you probably had more and more traders talk about a head and shoulders pattern. And man, you can't trade a head and shoulders pattern till you break the neckline. I gave everybody this number called the April 12th low. We're going to talk about the April 12th low because that is important, and it held one more time. But the April 12th low in spiders held like a dime. Got a little scary. But just jokingly, I said, here's what a head and shoulder top looks like that hasn't broken the net line. Never you'll get soaked. Guess what? That has a lot of relevancy because that's what happened to people today. They got soaked. They anticipated the head and shoulders pattern. So let me go over and talk about the head and shoulders pattern real quick with you guys. And now let's revisit what this thing looks like, because I'm not sure you're going to see, you know, while that may have been a head and potential shoulder, let me give you a little life lesson about old school stuff. And when I say old school stuff, I'm talking about stuff when I first got in the business from like 1977. Many people don't know this about me, but I worked for George Lane. George created this indicator called stochastics. I worked for George for 2 years, from 80 through 82. And one thing that we noted back in the old days was the correct symmetry. And a head and shoulders, the left side should be almost equidistant as the right side, and it helps you time the market. It helps you time the market as to when the market's going to break down. Another little life lesson. Many times you see something called a wedge or a pennant. And you know this rule. You never want to see it go past the 75% mark from the mouth to the apex. If it starts to compact and contract and go past and get through that, it's probably going to lose its efficiency of a pennant. It's generally towards 75%. That's where you get the breakout or the breakdown. Just simple little rules that give you an edge when using patterns. So when people, in fact, if you notice here on this particular chart, that little purple line in the sand is based off the, and I'm going to bet, maybe I shouldn't because I'm old, but I think, and I'm pretty sure, that is the April 12th low, because that's something that's in my DNA that I've been saying for quite some time. And that is, again, the April 12th low. Now, we traded, the key is, it got ugly last week. We traded below it, but we didn't close below it. And with the amount of people thinking that this market was a what? Head and shoulders top, and now we have a breakout. So what's going to happen in the market now? Let's try to anticipate. This is the breadth in the S&P 500. And if you look at where the reading is right now, we're getting close to the level readings of these old highs. The market's tried to go down, right? It tried to go down. It got a lot of people thinking there's a head and shoulders top. We have a strong accumulation here with breadth. The only thing we don't have is a lot of volume. Volume is just non-existent as much as it was over in this rally, or certainly back in February and March. I mean, that was a strong trend of volume. So here's what I'm reading and the kind of tools that I use, right? A little psychology, the fact of experience of knowing about a head and shoulders top that doesn't work tends to turn into another pattern. And the pattern that I'm thinking that this is going to turn into is kind of a little bit of a triangle breakout pattern. At the very least, we should see possibly a retest of the highs and maybe slightly higher. If this thing is going to launch slightly higher, I'm going to be quite honest with you. We're going to have to see some volume, looking at the OBV, creep in. At what level? You know, you want to start to see the OBV pop up, and you want to start to see breadth analysis really of accumulation take off. So looking at the rest of the market segments, the NASDAQ, and of course the NASDAQ composite, volume wasn't really there. And that was a pretty dynamic move, and on the heels of what? On the heels of biotech. So let's take a look at a couple little things together. And let's go with net change, and let's take a look at the strongest sectors today. Housing, because we sold a lot of new homes. XHB, anything that goes in a home, obviously. Broker dealers, which broker dealers had a nice little pop based on some analysis that we've had. Semiconductors, and then lo and behold, the IBB. So when we take a look at the market here as a whole, and I go looking at the Qs, the top weighted sectors, housing, stuff that goes in housing, broker dealers, semis, biotech, those were your top performers today, right in there. Those were the guys. And then, of course, you look at the Qs. We're looking for what really jammed today. And if you look at the not just the ETFs and the sectors indexes like the NYSE or the Qs, if you take a look at in between the lines or the spiders, I'm talking about what I like to look at is tell me the sectors that moved. Healthcare up 1.4%. What didn't move? The defensive stuff, TLT, gold, and GDX, obviously, right? But look at this down here at the low end of the spectrum. Transportation, materials, energy really didn't budge the dial a whole lot. Utilities, consumer staples, XOP, XRT, so Macy's didn't come back much, that's for sure, right? The heavy lifting was all probably contained, heavy lifting meaning over 2% in the stuff that affects the Qs. So let's take a look at the Qs real quick, because I think this Friday you're going to note a couple things. First and foremost, you're going to note one of my select patterns, which hasn't happened, but you will see that that was a doji. And what's interesting is that we are starting to see, and I think you'll probably note here, if this is a trend, A, and if this is B, and this was a small little short-term pullback, if we get a high close doji, meaning the market closes over the high of this weekly doji on the Qs, we're in for anywhere from a timing element of a 6 to 8 week rally. And most likely you're going to see a move capture a retest of 111.44, and if this thing really wants to get some legs, and it's going to have to get legs by a surge in volume, you know what? It's going to take a lot of people by surprise. And I would say that until you break down below, and And again, I know Friday's a long way, and we probably won't do one of these webinars for a few more weeks, at least going in. And I know we've got a special one with Thinkorswim coming up in a couple of weeks. But I'll tell you what, guys, if we end up generating a weekly buy signal and close over that high, you certainly could see a launch in the Qs that's going to surprise a lot of people for whatever reason. And so what the sectors that are moving are the ones that we've been talking about: software, biotech for whatever reason, and you know, I don't think it's just going to be one name called Apple that lifts the market. Now, here's one other thing that I want to get into your heads that we kind of pay attention to. Not only are we looking for today, for example, what I put out this week was if the market closes over 107.48, next stop 110.37, maybe 111. This is based off the Qs. Now, you know where we closed today. Hell of a move, right? So the Qs are at 108.46. Well, they went a little bit beyond the 107.48. So I think you get a not today, maybe tomorrow, a little day or so of pause, and as we get a launch of accumulation of the NASDAQ 100s moving in that direction, so it's not just one or two names, heavy weighted, that are a factor on the Qs, but an assortment of stocks that go up and weigh in on the Qs, then a directional trader is going to have some upside for the next few more weeks. One of the caveats that I have to point out to you is this: we need to see some volume kick in. So Friday, first and foremost, as long as we are maintaining above the high of 2 weeks ago over the next 2 days, it's a buyer's market. I think everyone kind of assumed that, right? One of the other concepts besides being a contrarian, that if everyone sees a head and shoulders top, it probably isn't one. But one of the main culprits, by the way, how many of you folks remember back earlier this year, and I'm going to just use this chart just for the heck of it. Just let me use this chart off of our this Word doc here. This is called the High Yield Growth, HYG. How many of you guys remember this thing? You remember this thing, the High Yield Growth ETF? This is the corporate debt yield ETF. You know, this is one of the things that we talked about in our trading community, that if the market is truly going to be bearish, now it's not tick for tick, but the spider, the S&P 500 is the black line, and the candlestick is the HYG. But I want you to take a gander with me here real quick and look at the correlation of the moves in this market. So if everyone was bearish, if everyone was looking to be bearish in the S&P 500, by the way, look at the volume accumulation that came into HYG. And you know what? It was starting to show that the HYG was actually leading our market up. It was leading our market up. Let me go over and share this with you in real time, okay? So if we take a look at HYG, let me scale this into range for you, and I'll tell you what you're looking at, okay? First off, we're looking at a momentum indicator, which this is actually kind of fascinating here. This is the HYG. This is a daily chart. Here's your high yield corporate bond ETF, right? And we note that if you remember this thing last year, here's what you might want to remember. They were talking about high yield debt. The spread between corporate debt and treasuries was getting decimated, and it took the U.S. stock market down with it, right? That's what you probably should remember. They were hammering this thing, and it was the reason why everyone said you got to puke your stocks out, you got to get out of stocks, because corporate debt's going to hell in a handbasket. And all of a sudden, we started to see like some stochastics bullish convergence, a little volume convergence on a special indicator we have, We started to see the momentum indicators start to show higher lows as price was making lower lows, right? And all of a sudden, you started to launch, you started to get into a trend. OBV was starting to get up, stochastics went up, the volume went up, the momentum went up, and then the rest is history. All right, so watch with me. If we're supposed to be bearish, and if this was, as I just shared with you, an overlay between this and the correlation to S&P 500s, then guess what? If corporate debt, and I want you guys to listen because this is easy to follow. Back here in January when everyone was saying to sell, I want you to look at this date, 1/19. On January 19th, running our daily scans, I found an enormous amount of preferred bank stocks with PPS buy signals. Let me repeat that. On January 19th, when the world said get out of stocks, sell, it's going, this is the big kahuna, this is the crash. On January 19th, we found a boatload of financial stocks, mainly Citi, Wells, Bank America, PNC, preferred stocks that were paying, you're going to love this, anywhere between 5.75 and even as high as 8% dividend yield on those preferred bank stocks. They were being populated with the PPS buy signal scans. What does that tell you? This is what it tells me. It tells me that very wealthy people who think, or very smart people, think that at that low, that the banks got beaten up so bad, they wanted to put money to work, and instead of being in a common stock, they wanted to be in an interest rate, high dividend yield to have participation in the market. If you think the market's going down, the last thing you're going to do is buy a preferred bank stock, right? I mean, it's just not the thing to do. And if that's the case, looking at the high yield growth corporate debt ETF, it's something that also reflects the what? The debt of corporations. And if you have people buying, then it's going to be bullish more for the overall market. And so it has been a leading indicator. And I've got to give the guys credit back over here last summer when this thing started to puke. It was a leading indicator because you know what happened. It was already in a downtrend and the S&P's puked. And so now what's been happening though? So my statement has been what's been good for the goose, in other words, if it's a leading indicator that points the spiders to go down, then it should be good for the gander, and it should be a leading indicator that the stock market goes up, right? Good for the goose, got to be good for the gander. So here's the story. While we do not, I don't really see a head and shoulders top pattern here, what I do see is a high closed doji, monthly support, a last conditional change, and yesterday's tweet, this was one of the things that we were kind of talking about in the HYG, a couple other markets, that we were starting to see a more supportive market. And if we do kind of, which we cleared this little dotted area here, if we can get a little bit of launch, I'm thinking the next target, and again, here's the thing, next Tuesday, we finish the month, we get a new month. But if we close closer to the monthly highs in HYG, so we are actually on the highs right now, right? So this is the month. If we close closer to the highs or a new high, how can you do anything but anticipate it wants to try to get up a little bit higher? And what could it do if it gets up a little bit higher? Most likely it's going to be a leading indicator for the overall market. We want to be watching volume indicators. It's starting to see some bullish momentum. The stochastics, this is a fast stochastics because I don't like to have anything slow. I don't need delayed action. And I need to see a little bit of the OBV, but everything else, the momentum is still looking positive. So one of the good leading indicators in the market right now, besides the fact, and this is what we wrote about for this week, guys, right, is that, by the way, I expect to mark that the overlay in the S&P to HYG It's not 100% correlation for every tick up or down, but it has a strong trend correlation in the technical picture on HYG. Based on my indicators and OBV, the market looks like it wants to reach the person's quarterly pivot resistance, and that's 85.75. And that translates to last year's highs areas, right? So my thoughts simply this, that there's some strong longer-term accumulation in HYG, and maybe there's a surprise move that this equity market might see more upside than we think. I'm looking for maybe another 2-3% in the Qs. It could be a little bit more. We need to monitor to see in the next couple of days if volume comes into this market. So I implore you to watch what makes up these markets. What makes up these markets, these subsectors have a lot of weight. We've got a biotech conference, some big ones coming out in the next 2 weeks. Biotech had a big move today. It can move a lot more. And I think that between that, the computer software, and some of these semis, you know, and the fact that a lot of people are not long this market or short, this thing was a little bit of a squeeze, but we could see continuation to the upside. So I think there are some tools out there. One of the tools that, apart from technical analysis and looking at, yeah, sure, the market broke out of resistance. Yeah, the market didn't break down below support. You know, yeah, the breadth of the NASDAQ 100 was not making sharper lower lows. It was stabilizing. But relative strength analysis, number one, is very helpful. And also this strength in numbers concept that I put out for you guys in the beginning, right? This concept right here, this strength in numbers, it certainly is something that you don't see on a day-by-day basis. So while a lot of people look at maybe the NYSE Advanced Decline, the tick, the McClellan Oscillator, or the ARMS Index, I think a lot of people are not looking at the real under the hood. And this market is a very technically advanced, sophisticated environment with all the computer-generated algos that are out there running the roost. This market, and I think, has been frustrating a lot of people. It's evident that it's frustrating people because I know we did it in our trading room, and I'm going to ask you, you look at options, and that bid and ask is no longer as tight as it once was in options trading. It's getting pretty wide, right? And it has for the last few months. And I think it's because it's a lack of activity in the market, and that might explain obviously there's light volume. So the market has done a really great job of making idiots out of as many people as possible for as much as possible. And I don't mean that in a disrespectful way, but even for myself, if I say the market's going to go up today, it goes up tomorrow. If I say it's going to go up, and I think we have to understand what I've been training my traders is that this one word, and it's this, tricky. The market has been very tricky and is going to continue to be very tricky. And I'm not going to put down 100% into seasonalities, but I can definitely say if seasonality tells me to spot for strength in semis, if seasonality tells me to spot for computer software companies and for biotech, by God, I'm running scans in that area. Now, I know that this is probably way too much information on this screen, but you know, right now at 5:53, I'm going to just share with you today's. This is a live scan that is today. Cool, excellent. All right. So now I understand there are the scans, the PPS indicators from that you can get on Thinkorswim with the PPS. But what I want to share with you is also looking at what populated today under this type of criteria. How many daily buy signals occurred today when the weekly was in a buy mode? That's powerful because what that means is if the weekly is in a buy mode, this is a weekly chart, this is a monthly chart. If the weekly is in a buy mode, number one, and the daily's in a buy mode, number two, that means the short term is in sync with the long term. And that's what that right there, number one, has to do with. And just to help you guys out, right, let's find out a little bit more savvier. What really populated today under that criteria? Some basic material stuff. That's pretty interesting, right? Sunoco products and basic material, you know, it's going to form a weekly buy, so it's anticipating, and I don't really think that's a great setup, to be truthful. I don't think GE is going to be a high beta stock, but you know what I definitely see here, the combination is that we're maybe a very short-term couple days away from a daily high close doji. We had one here on GE the other day, and it's up a tad, right? I'm just picking out names that I, can see, which I find funny. Pulte Home Group, PHM. Well, we understand why PHM had a big day. And anyway, what I'm going to move down the list here is I see Hildebrand, and I know that's a Johnson Outdoor, Textron. I go on down the list. I got energy, and then all of a sudden, guys, look at what we are going to populate today. Tons of financials. Tons of financials, and then some healthcare. A lot of these healthcare, Biogen, we know who they are. So financials and healthcare today generated some upside. I'm going to bet instead of looking at the ETF like the spiders and the Qs tomorrow, I'm going to start focusing on maybe some option strategies, bullish option strategies, and maybe some, I don't think there'll be a lot of premium in any put writing strategies. But I'll tell you what, I think there is a strong chance for some of these biotechs to see some more upside. I'm seeing, as you can see right with me, I am not cheating. I haven't seen this before. This is live right now. Services. I see a lot of services. Restaurant. I noticed Texas Roadhouse. Never been in one. Famous Dave's. I'm seeing a consolidation or concentration in those stocks, in those sectors. And then all of a sudden I start scrolling down and I get technology. Oh my goodness. So that's pretty good. Mobileye. Now let's be fair. That is the buy number one. Let's go to sell number two and say, or sell number one. Let's keep it real, right? Show me how many daily sell signals. On a day like today, any stock that generated a fresh sell signal, I don't think I want to be in it, right? Haynes brand generated a daily sell signal today. It's in a weekly sell. Look, there's the PPS sell. It's in a downtrend. It tried to go up. It's failed. Haynes brand. And in a monthly chart is down. Now, apparently, they may be paying Michael Jordan too much for the underwear. I think this is the Fruit of the Loom guys, right? So I haven't seen their commercials on TV. But a stock that doesn't go up with a market that went up like today, I tell you, it's probably got a little bit of some problems. So their tighty-whities are scrunching on these guys, right? Anyone that's long this market, you probably see a little washout. It's only a $26 stock, but Fitbit, what the? And then Fitbit, I mean, a $13.90. It's in a sell mode on a weekly. It's in a sell mode on a monthly. It's in a sell mode on a daily. You got to stay away from this stuff. We know why Best Buy generated a sell signal. It's in a weekly sell. They gave poor guidance, and it's in a daily sell. I mean, obviously there are a few names, but nothing near compared to the buy signals that we got. All right, one last thing I want to share with you. How many stocks generated a daily buy signal today? And what was the concentration of stocks? Now, these are all kind of, these are like preferred stocks if they don't have a sector listing. So just to show you, can see Newcastle 9.75%, Renaissance Holdings 5.37%. So those are all preferred stocks right there, and that one even says preferred. There it is. So as we go through, we've got basic materials. Oh my God! So basic materials. Obviously, Valspar. This is a paint company. Anything that has to do with putting something in a new home, paint. Anything that has to do with Nucor, which is a steel company, that's kind of counterintuitive. But Bemis, another counterintuitive one that just generated a daily buy, unfiltered. we generated a lot of not positive net change on the day, but something that created that algorithmic buy signal. What I'm trying to spot and share with you how I use tools to identify what went up, because sometimes the indexes go up more and then a stock will follow later, right? So if the equity indexes go up way too much, maybe we look for opportunities in a subsector or an individual stock, and we can look for some trading opportunities there. That's what I'm trying to get at. Look at the basic materials, the amount of basic materials. So basic materials, maybe XLB. Let's take a look at the XLB, because if a lot of material stocks generated buys today, the more buys in a sector, the higher the probability and the stronger the follow-through might be. So tomorrow, or at the very least, I would identify if this market was a slight pullback, maybe it can launch and get to testing the 48 area, the high for the year, because this looks pretty strong on a weekly basis. 48, 49 wouldn't be something that it's out of the realm of reality. So buying pullbacks, selling premium below the market, at least for the next week to 10 days, might be a pretty safe play. That's for an option strategist, how I'm getting my ideas. Capital goods, going through the list, I mean, all the way down, energy, and then financial. It would take me, to go through every single one of these stocks, it'd be impossible. So let's take a look at KRE, the regional bank ETF. It's breaking out, and you know what? If we break out and close above this gray line in the sand, that's a last conditional change, this thing's gone. I think that you're going to see finally the KRE get back to where the pre-Janet Yellen and Fed Open Market Committee raised interest rates, and as a long time coming, the folks that were buying preferred stocks here are going to probably see a payday. And so if we get further momentum breakout on the KRE, which is the regional bank, you can see this here, the regional bank ETF, you might get some stronger liftoff. So there is a rhyme and a reason of what we look for when we try to do our work and what the computer's heavy lifting is about. And it's just a matter of learning how to trade and then go with a directional trade. So whether you're trading an option strategy, directional, understanding the time frame, man, this is really clear-cut information that's been helping us to navigate these markets. And many of you were here just 2 weeks ago when we were talking about watch for gold to go down and watch biotechs to go up, and that's what we've been writing about. Now, I've taken enough of your time, but I wanted to make mention that we have my weekly thoughts and observations. I put this out before. It really is a dynamic product, and I mean that. It is like almost getting to the point where it's becoming epic, right? We talked about GDX a couple weeks ago, the IYR topping out. Look for the Qs. I mean, I could go on and on, but I would like to give you guys a special offer and a Memorial Day special. We haven't done this in an awful long time, but if you want to take a test ride on the weekly thoughts and observation, it's $49 a month. If you want an annual discount, it's $547. And if anyone's interested in taking a year with me, we're going to give you, we've never done this before, the Advanced Traders course. If you want to learn about stocks, if you want to learn the right way to use OBV, advanced decline analysis, chart pattern, correct chart pattern techniques, the Advanced Trading course is fantastic. I'm here to tell you, it really is the epitome of a great trading course. If you want to sign up for a year in advance, by all stretch of the imagination, if you don't like it, we've never been one to never give people's money back, that's for sure. Keep the course, but it's $547 for an annual discount if you're interested to stick around and see what we can do for you guys for the next year at least. So with that said, bonus, sign up for the annual discount, you get the free trading course, the Advanced Traders course. This one right there is just, I mean, it's fantastic. I have nothing more to say about it. And I know we've had a lot of people make comments in the room today about using my indicators on toss. and talk about a lot of things that have been going on. The Advanced Traders course is over 6 hours, I believe William A. just asked. If you're interested, click on that link. I'll tell you what, it's been a pretty powerful, and not only is it a learning curve. I mean, just this week's, besides 2 weeks ago, the prior weeks. I mean, just look at what we talk about, where to get you guys to look, specific levels to watch for breakouts. You know, the amount of work that goes in here, the amount of studious, not many people look into stuff like this. This is institutional grade. By the way, just to joke around, I don't think we're going to see great earnings out of some of these other guys, but one thing I did make mention is that I think Guess, which formed a daily HCD, if I had to guess, jokingly, what smart market might rally, either Express or Guess, it might be Guess doing a little bit better. I only remember Guess is doing the the Brooke Shields commercials. I don't have any idea what they do, who they market to. I have no clue. I mean, I've never seen them in any of the malls. Maybe I don't go to the right malls, but I think there's a shot for an upside move on Guess. But to be truthful with you, they're pricing in about a $1.75 move. There's your high close doji. It's at monthly support. It had some pretty decent OBV. You know, there's better trades out there, and I'll be honest with you, there's been a lot better trades after earnings than there have been before earnings this earnings season, and that's something that I think that's important to mention. The technical points of interest to teach you what all of this information is. What are we dealing with in these bullet points that are so darn important? You know what? That's why this special is awesome, because guess what's in the Advanced Traders course? You want to learn about advanced decline levels. You want to learn about McClellan Oscillator. You want to learn about the scans that we do with 50-day MAs. How many stocks in the S&Ps were above their 50-day moving average on April 20th? You know what? Close to 400. Last week, only 262 stocks. So what was funny is the prior week was 256. So we started to see more stocks get lifted off last week, and now this week we got a little lift off. When we start getting a little bit overbought of how many stocks are above a 50-day and below a 50-day, that's important information. But here's one of the best ones. How many people, CFTC, small specs, are still short 11.7% of open interest in E-mini S&Ps? Owie, owie, oxen free. That's got to hurt. So after options expiration, people were still committed to the short side of the S&Ps, and that's why we got such a launch today, or you know what we were kind of looking for. So this is the kind of stuff that we put out. Now I know that some of you have TradeStation and some of you use Thinkorswim. I every single week use Genesis. It's just I've been doing it for 12 or 14 years, and because of algorithmic changes between a price settlement of one chart and another, here's my deal. I just use the Genesis because it's consistent. So, you know, one day you get like Thinkorswim PPS indicator might give you an earlier buy signal than this system, and some days this system might, so 10 to 1 or the other. And I don't like to switch around. I like to be consistent. I'm just trying to explain to you, so don't feel jaded why I'm just using these charts. I'm not, I'm just being consistent. But one of the funny things is as a follow-up that we did from last week, by the way, I just want to give you this, a weekly close below the 34, April 29th low, and 31. If we close below this 1231 on GLD, by the way, or gold futures, guess what? I see about another 4% move by mid-July. That puts you into the 1206 area, something like that over time. So Friday, by the way, if we close below that level on a weekly basis in the next 6 to 8 weeks or so, I see a market back down to the 1195, 1206 zone. That equates to about another 4% move. As we get through this, by the way, we also stop putting out specific trades on Twitter, so you won't be seeing HCDs and LCD warnings on Twitter anymore. We moved back because people have asked to move back to email alerts. So this advisory service, which has grown into that, is going to show up as an email form instead of saying, by the way, here we had this last Monday. By the way, we've got SMH, IBB, and XLK triggered daily PPS buy signals. That was probably important information to know. And then Facebook flashed a daily sell signal and went down for a couple bucks. So these are the kind of things that we put out each and every week. This is our seasonal for commodity traders. This is pretty cool stuff right here if you like commodity trade spreads. Everything that I put together are anywhere from 25 years or life of history. Listen to this carefully. Life of history. So if a commodity has 30 years or 1968, life of history seasonality, I take a study, and I've done this for decades, and do seasonal spread analysis. And what we put out are these spread trades when you get in, what they mean, and to be honest with you, they are pretty dynamic. I mean, end of story. This is the hash mark here, by the way, is the date of entry. So in this spread, you want to be long the spread. That's the entry. It's making money. This one just triggered, making a little bit of money. This one is a feeder cattle, live cattle spread. It's just taken a little bit of heat on it. This one just triggered, and I think it's break even. And this one just triggered right here, and that's a soy meal. So that's kind of like the concept that we put together for this newsletter. So if you say, and I had someone tell me, you know, this is a lot of information. There's something here for everyone. But here's the best part, right? Here's the seasonally strong sectors, and here's seasonally weak sectors. Bullish high closed doji if you don't know how to trade these, and bearish LCD patterns if you don't know how to trade these. If you sign up for this, guess what? The Advanced Traders course tells you exactly what you need to know for the entry, stops, exit. And then again at the end of the week, at the end of this week, talk about preparing, because this is a weekly thoughts and observation. Reports and events, earnings that are coming out so that you're prepared what's coming out, and it's all contained in every week. And guess what? This gets emailed before the market opens on Monday. No, it gets emailed generally on Sundays, and lately we've been doing it on Saturday to allow people to read it and start their process of looking for better trade setups. So if that's not enough, Monday mornings we come in and we review this in what's called planning and scanning. It's recorded, and then members have access to those recordings. So that's what this is all about. Specific trades, emails, comes out every week, and it really covers the gamut of the market. If you're interested in this, I would absolutely say this year you guys have been around enough of our webinars. If not, I think, you know, take a test drive. It's $49 a month. It's every week though, right? A $500 annual discount. If you go with the annual discounted rate, we're going to let you have the Advanced Traders course, and this is a dynamic product. It's literally, I don't like to use this word often, but it is epic. And you know what? We've been doing things right this year, and it's not just about day trading and looking for breakouts. It's tagging the right sectors and being in the right space ahead of the crowd, because we notice what's being picked up in the market by these scans. It's very powerful. So today's presentation was to give you insights on what we're expecting, what are the techniques we've been using, what's really kind of helping the market give us that edge, like the spread relationships and the percent changes. So that does conclude today's session. I am sorry for going 13 minutes over because I was here 5 minutes late today. I can't believe it. I want to say thanks all for being here, and if there was a, and I don't know if I asked all the questions. Wayne says you dropped the knowledge today. I did drop the knowledge bomb today, and I'm sorry of that. Alan Haynes says, I already have your Advanced Traders course. Can I offer something else if I'm in for a year? Alan, call the office. That's a guaranteed yes. Okay? That is yeah, absolutely. But that I think if you're interested in one of our other courses, yes, Mary is we're pretty reasonable people. All right. Patrick says he's grateful to spend time with traders. This is a great chat. You know, we do customer appreciation. I show you guys great products. You know, a lot of my thoughts and ideas are, you know, they say plagiarism is the greatest form of flattery. You know, a lot of the techniques that I put together, I've never put out one technique, and I've never taught anyone that there's one individual indicator that's the holy grail. But combined with a few of them, it's like that epoxy glue. Combining one with another, man, you get a strong bond. And that's what we've been finding out and showing traders. It's not just about price indicators. It's got to be condition. It's got to be a little bit of everything. And it really has been a wonderful year. And that's about the and I think that a lot of you guys are have been coming into our webinars. You know that we've got a lot of you guys thought that this was something that, oh gosh, it was just going to be a quick snazzy thing on today's action. And you know what? We followed up with a lot of this work. You know, when I first started in the markets back in at the Merck, 1977 as a runner, working for George Lane in 1980. Let me repeat this again. I don't know if you, 1980. I mean, 1980. That's when I sat next to George Lane. Uncle George, I called him affectionately, everyone called him Uncle George actually, and his wife Carrie, 1980. And I sat 24 inches, less than that, next to him, side by side, watching him day trade soybeans and live cattle. You know, he did corn as well, and boy, that was really instrumental in the people that would come to visit George. I mean, I don't remember half the people's names, but they were, you know, when George got up out of his chair to shake someone's hand, they were somebody. We had, I mean, Orion Samuelson from the Farm Bureau report come in the office. I mean, the list just goes on and on of people that you'd never know. There was a guy by the name, just to give you a little story, Ellis Pixley Luke. And this guy was about 90 years old, 6'2", frail as could be, came in every day, friend of George. Turns out the guy's family like started all of, I think, Barrington, Illinois. You know, they owned like the whole county of Chicago back in the 1800s or whatever it was. And this guy laid on to me a book about cycles and the Kondratiev wave cycle. I mean, that's the kind of stuff I was introduced to when I was 20 years old. To have that kind of a mentor and to listen to that stuff, to learn about the commitment of traders report and seasonal. If you didn't understand, you know, the seasonal lows in planning and the seasonal high by the 4th of July, I mean, by God, you had a problem. So I had all of that influence by being there working with George. And it's just that I needed to make a little bit more money, and many of you know I transferred myself because I thought I should have been making a little bit more money, and I went off and started to learn how to trade financials, the bonds, and then when they came out with bond options in 1984, I learned how to leverage my leverage using options. So I mean, from my time frame in this business, by the time 1986 came around, many of you know I did really outstandingly well. Knew a lot of people in the business, all the top names. You know, that was the era of commodities. Anyway, it was a fascinating ride. It's been a fascinating memory lane. But you know what? Through the decades, the one thing that I still do every single day is Person's pivots, the PPS indicator, and everything that we outlined today is really nothing's changed in my analysis. What has changed is the way we are delivering the information via computers, the way that we are able to trade options, equities, ETFs, inverse, reverse, leveraged. It's just, you know, the one thing that's actually happened is I probably trade less commodities because there's more volatility and money in a lot of these equities. But in any event, I'm sorry to go down a little track there with you guys. It's been a long time. It's been a great ride, and I think we're on the right path to what's going on, and I don't think it's going to stop in the next couple weeks. We got an interesting summer. We got an interesting year. We got Donald Trump to stir things up. We got Hillary Clinton to unstir things up. We got the ECB. We've got the Brexit. We've got, you name it, we've got it. It's going to be here. We got OPEC June 2nd, I think it is. So there's always something here. Anyway, I hope you're with me. I think you'll find this a fabulous opportunity. Take advantage of it. In the meantime, we'll see you in the next round. Everyone, have a great, safe Memorial Day holiday. Remember, I think I can't say it better, so I'll just point it out to you guys here. I think this says it all. Remember a thanks and a moment of gratitude and a prayer to those who gave us the greatest sacrifice to our country, because that's what Memorial Day is about. With that said, have a great 3-day holiday weekend. We'll see you the next time. Thanks, everybody.